Ali, an eventful start to 2025. A lot has changed. We can't not talk about tariffs. What impact will they have on the technology sector? And do you think we're past the worst?
It's been a volatile start to the year. Some of that turbulence is to do with the new technology cycle. We think AI is the next general purpose technology, and when you have new technologies emerging, there is inherent volatility to that early cycle. You don't have many data points, or when we use the technology, we can see its potential profound implications, but we don't really know the end state. On top of that, we've had a second layer from volatility emanating from the White House, if you like, around geopolitics, around trade talks, tax bills going through, and numerous other things, which has, I suppose, compounded to give a market backdrop that has been choppy. Now, I think we've navigated, and the sector has navigated that fairly well so far, but we would expect that to be a recurring feature of both the AI story and, I think, global markets, certainly for the rest of this year.
In terms of the technological volatility you mentioned there, DeepSeek is the obvious one. Now, a few months past the DeepSeek moment, how do you reflect back on that?
DeepSeek was, for us, in some ways, the bigger story than tariffs in Q1 for the AI trade, because we had the emergence of a model from China, which appeared to be, at least at first blush, much cheaper, nearly as good as the models from leading US labs. And that violated a couple of AI narratives, if you like, that you had to be American to be leading, that you needed access to the latest and greatest and most expensive NVIDIA chips. And then a lab comes along and does something ostensibly quite similar with much less. I think the sort of numbers around what the model actually cost to train have been contested. And the real news has been that DeepSeek is another point on a cost curve that we've seen with lots of other models, where the performance of models, and particularly the cost performance, is improving at a very, very fast rate. And if you are AI maximalists, which we would describe ourselves as, that is a feature of a new technology cycle. You need to see the technology improving at a very, very fast rate in order to open up new applications, to make things that were not economic. So we think that that's a feature of new models. And we've seen a decent rebound in some of the AI infrastructure stocks. We've seen all of the hyperscalers, the largest cloud companies who are making the investments with their own capital in AI. We've seen them continue to increase spending. So for us, we think that this is a point on the curve, something to be aware of. It maybe has made the AI story more complex than it was before. But we are very, very encouraged by the fundamental progress that we're seeing in models, in AI adoption.
Okay, now what are the risks of another DeepSeek moment, or is that just part of how this is deployed over time? You're going to get more volatility, you're going to have another moment, there's just going to be other things to worry about.
We expect that there will be other shocks to the AI story. There will be other data points that are not bullish AI. And if you get two of those in a row, it's very easy to extrapolate and declare the trade over, or declare we're at peak capex, or whatever, however you want to look at it. We'll also get good data points. We think that there is a very good chance that AI will surprise to the upside, whether in capabilities on the model side, whether in adoption, whether in the rapid scaling of tools like ChatGPT. Now it's reportedly 800 million weekly active users. That was not a number that people were expecting 12 months ago, say. So we think there will be surprises, both positive and negative, which will bring some turbulence, but our job as active managers is to help navigate that turbulence.
You've mentioned artificial intelligence a number of times there. I think I know the answer to this. I'm going to ask you how infused you are about the technology. Does your passion remain? But also, what's the next stage of its development?
We think we're at a very, very exciting moment in tech. We think artificial intelligence is the next general purpose technology. We think it's a rare example of discontinuous technology change, where you get a lot of progress in a very, very compressed period of time, and that the implications of this, both in the tech sector and outside it, are going to be very far-reaching. What is tricky at this stage is to give a comprehensive view of the end state of how AI plays out, which is why we are primarily positioned in the infrastructure side of the trade at the moment, but we're keeping a very close eye on the early applications. This is going to change everything. And we think the economy is going to change. We think industries are going to be reimagined around AI in the same way they were reimagined following the arrival of the internet. And we think there's actually some regional parallels with that mid-1990s period. The volatility was a feature of the mid-90s. I think between 1995 and 1998, the Nasdaq returned 350% before we get into the 98-99 bubble. But during that 350% return, there were 7 periods of 15% or more drawdowns. So these drawdowns are a feature of the market, and we would expect that to continue. But equally, the prize here is very, very large. AI is a general purpose technology that can address a large chunk of knowledge work. There will be new markets that are created on the back of AI that today we can't imagine. So we're very, very excited about the outlook. We're watching model progress, probably more closely than anything else, on top of the adoption and where companies are seeing it in revenues and all the things you'd expect us to be looking at. But we think that is the first part, the prime mover of this story is the progress of the models.
Okay, now coming back to the macroeconomic backdrop, there is much uncertainty and it feels as though the chances of a recession in the US are certainly higher than they were 6-12 months ago. What effect does that have on the technology companies that you're investing in, and what's your base case in terms of the economic outlook?
The really encouraging thing from Q1 is that we saw the largest cloud companies who are investing the most and their own dollars in AI CapEx, they all increased their CapEx expectations for the year. So we think that is an encouraging sign, despite the fact that uncertainty indices or macro uncertainty or consumer confidence were actually not looking like the kind of environment where that might happen. And there was certainly a lot of hand-wringing into results about whether companies would pull back or would temper expectations. And to our view, they really didn't. There was no evidence of that. Not to say if things got much worse, it couldn't happen. But for now, companies are pressing ahead with AI investment because they see the scale of the markets to go after. They see the scale of the opportunity. So I think, could a softer macro derail the AI trade? I mean, a very, very soft macro, a deep global recession could derail anything. But absent that, we think that the story remains just too good and the opportunity too large for people to pull back. And we've been thinking about this current environment as a period of recalibration in global trade, in the global macro environment, even in the market environment, rather than a full reset. And our base case remains that it is not within policymakers' interests to provoke a global recession or deep global recession, and it is still within their capacity to resolve it. Now, that capacity is not infinite and it doesn't last forever, so we need to see trade deals signed quickly. And to be honest, the more and the quicker, the better. For now, we think that the macro environment is not bad enough or is not looking bad enough to derail the AI trade.